Imagine opening an envelope to find you've just secured a massive salary bump, hitting that magical milestone of 1 lakh rupees a month. Your immediate thought is probably that your financial struggles are over. But look closely at the data, and you'll find a jarring contradiction. A massive percentage of these top earners reach the final week of the month with a bank account hovering near zero. To understand why, let's run a simulation with two people. They both land the exact same high-paying job, earning the exact same salary, starting on the exact same day. Fast forward 10 years. Earner A has laid the foundation for a multi-crore net worth. Earner B is drowning in a cycle of financial anxiety, barely keeping up with rolling credit card bills. The size of their paychecks was identical. The massive divergence in their net worth comes down entirely to their hidden financial habits. The first hidden mechanism destroying wealth is lifestyle inflation. There is a powerful psychological trigger that activates the moment our income rises. We immediately justify upgrading our baseline. That higher salary turns into a premium phone, a larger car, weekend dinners, and a stack of recurring subscriptions we rarely use. This chart shows how this behavior breaks your financial math. Income scales upwards, but expenses mirror that exact trajectory. The absolute numbers flowing in are larger, but because you spend every new rupee, your actual savings delta remains flat at zero. You successfully create the illusion of prosperity while actively neutralizing the wealth-building potential of your new salary. The second mechanism is the normalization of buying consumer goods through EMIs. Equated monthly installments manipulate our perception of value. They take expensive, rapidly depreciating assets and make them feel cheap and accessible to us in the present moment. This calendar grid represents your future income. Taking an EMI actively locks away chunks of future paychecks before you earn them. Stacking multiple EMIs creates a cumulative drain, leaving a razor-thin margin for actual wealth creation. Relying on these installment plans transforms a high earner from an architect of their future wealth into a perpetual manager of their past debt. The third fatal mistake is procrastinating. It's the habit of delaying your investments until you hit a higher salary tier or until you find the perfect time to enter the market. The most critical variable in the investing equation is not the initial size of your capital. It is the length of time that capital remains invested. This area chart shows how time dictates growth. A tiny early investment in Curve A mathematically outperforms the massive delayed capital injection of Curve B. By waiting, procrastinators miss the late-stage exponential phase of the compounding curve, permanently stunting their net worth. Time cannot be retroactively purchased. Delaying your investments guarantees that the mathematical power of compounding works against you. If we return to our two original earners, the contrast is obvious. There is a massive structural difference between the performative act of looking rich and the quiet reality of actually being wealthy. To build actual wealth, your first rule is simple. Every time your salary increases, scale up your savings rate and firmly resist the urge to upgrade your lifestyle. Second, eradicate unnecessary consumer debt. Refuse to let EMIs dictate your future cash flow. And third, abandon the idea of a perfect time to invest. Start immediately so you can capture maximum compounding leverage. A high salary is merely an opportunity. Extreme financial discipline is the execution. Out of the three traps we covered, lack of savings, excessive debt, or delayed investing, which one do you think is the most dangerous wealth killer? Let us know in the comments below.